No investment is totally risk-free. Makes you feel kind of hesitant, doesn't it? We get it. When learning how to invest, the biggest issue most people have is that they don't know enough about how to invest wisely, which feeds into the fear that they'll lose their hard-earned money. You're shaking your head, yes, right? It's what stops most people from investing and really building their wealth in a way that's impactful. Taking on risk is never fun, but it is all about the reward. It is important to define risk for yourself. For many, the more a stock has fallen in price, the more risky it is. However, we found that the risk of a business is often completely disconnected from the change in its stock price. Buying stock of good companies that are out of favor in the market isn't risky at all. But if you only focus on the decline in the stock price, you can be forgiven for thinking so. So, as a first step, define risk, which Webster defines as a situation involving exposure to danger. We have a slightly different definition. Risk pertains to permanent impairment of capital. Basically, what that means is that the more likely you're going to have to sell an investment at a loss, then the more risky it is to you as an investor. For example, in February of 2016, LinkedIn stock fell from $237 to $100. That's a 60% drop in price. Do you think buying it then was risky? Conventional wisdom says so. If it fell that much, then something must be seriously wrong. Now, remember our earlier point. Changes in stock prices, especially changes that big in such a short period of time, are often not based on reason, but instead based on fear. If you bought that high-quality business when everyone else was panicking, then you would have doubled your investment when Microsoft purchased the company in June of 2016 for about $200 per share. Now that is the kind of risk that we want to take. Leaving your money in a regular savings account is a bit of a risk too, isn't it? It's a risk that you'll continue to perpetuate the cycle of wealth that you're currently in. It's a risk that you'll never compound your wealth to the levels you know you're able to. So if you're shaking your head yes to all of this, just remember, no investment is totally risk-free, but certain calculated risk can pay off. Deciding how much risk to take on is called assessing the risk tolerance, and there's no really right way to do this. If you're investing for the long term, you'll have a higher risk tolerance because you're okay with waiting out the ups and downs and changes in the market. Here's an easy way to look at risk if you're a beginner. Take on more risk if you're investing for a long-term goal, like those investing for retirement. Take on less risk if your goal is to see returns that are slower but more stable. Ultimately, when it comes to risk and investing decisions, it's important to consider your overall timeline. What are your goals? Do you need to see returns in 3 months, a year, 10 years? That'll help you figure out where to start. If you decided that you're going for a higher risk tolerance, you can lower that overall risk by diversifying your investments. How? Own a variety of investments. It's the classic game of not putting all of your eggs in one basket, and it's wise. We have found that 8 to 20 positions in your portfolio is a good number to have when it comes to diversification. If you want to diversify your investments, you might invest in ETFs that are managed for you across different asset classes. There are ETFs for everything from commodities such as silver, gold, and oil to the safe but limited returns of government bonds to stocks. You can spread your investments out across these sectors and others to even out that risk. Remember, government bonds are one of the least risky investments out there. They don't go up a lot, but they don't go down a lot either, which can be really helpful to your portfolio of investments during market sell-offs. The goal here is to offset any losses or volatility that one single investment might experience. This diversified approach allows you to make investments that have risk but can potentially pay off big time. So, if you want to play the single stock picker game and risk increased potential for upside and downside, offset the potential dips in the market by investing in a few diversified ETFs. That way, if you lose a bit in any one stock over a few months or years, your overall portfolio will still continue to steadily grow. Ready to start building more investing knowledge? Download the Compound Wealth app for Apple or Android via the links in the description below. And don't forget to subscribe to our channel to receive weekly financial tips and content delivered straight to your inbox.